You know, it's crazy to me that just about several months ago, I really liquidated a huge percentage of my portfolio, like a lot more than 50% of it, to put a down payment in tandem with my fiance on a condo here in Toronto. And I was just looking back 7 months ago when I was doing these videos of my portfolio being worth $182,000, and skipping to today, like it's just insane at how fast the market can truly evolve, because we were really at bottoms. Well, the market was still pretty suppressed several months ago, and it's just been this endless rally. And I'm just shocked that here we are at almost 290,000, just several months later. And it really isn't much of a surprise. I'm shocked, though, first and foremost, that, I've taken some pretty big gains on Google. We've had a lot of dividends since the end of last year, especially when I started moving some of these things around. But we've got 42,000 in gains. Again, that's not including Google, anything else that I sold in the past. It's just what's currently locked in on this spreadsheet, whereas before we were only up like 2,000 after that liquidation event. But again, when the S&P is up 18% just in the last 6 months, Google did exceptionally well. I think I took an 18% gain or 17% gain on Google, when Tesla over the last 6 months looks abysmal. But when you've been like me buying it just within the last month, or both last, 3 or 4 months, been buying it, I think since February, we're now up 42% with an average cost of like, okay, maybe a little less, because I think our average cost is around 185. We can find that 185 mark. Yeah, we're up 35%, give or take. So we've been crushing it on this position. Not that any of that is going to last. Obviously, the market conditions could change at the drop of a dime, but I think this just shows persistence and not only just working hard and saving your money, but obviously just with the markets going up the way they've been going up, how quickly, your portfolio can change. It's just crazy. I hope this is somewhat inspirational, as the S&P 500 has not been the same for everybody. If you have been a dividend focused investor, I hope it was for the right reasons, because you needed cash flow. Because the reality today is that tech continues to be the dominant source of return, or at least high margin, software or technology like businesses, right? You take a look at just this last week and everything else is red except for the major tech companies, with a few exceptions of some of the banks, etc. If we zoom out on the last month, tech is still insanely dominant. You zoom out on the last 3 months, it's just crazy how much tech has been the driving leader in this market environment. And honestly, looking back, this should have been a little bit more highly anticipated. Though again, when it comes to tech, you would have presumed that in a higher interest rate environment, people wouldn't be spending as much money on products. But then again, this is showing the dominance of these companies on our daily lives. And because they are such high margin businesses, they have thrived in this high interest environment, while the rest of the lower half of the market that doesn't have the same liquidity, the same margins, the infrastructure oriented companies have been struggling so damn desperately. So let's just talk about the dividends versus growth. We're going to get into my TFSA, my RRSP. We'll do a bit of comparables there on where I want to see those accounts in the coming years, and just my personal short-term goals. And if that is a conversation you'd appreciate on your path to financial independence, to damn well retire early, hopefully one day retire early, consider subscribing and joining me on that journey and hitting that like button while you're down there, because the S&P price to earnings multiple right now is getting obviously exuberated by the upper weighted tech companies that have been dominating. And I feel like at some point, this euphoria phase is going to be put behind us, and we're going to go back into a market that we eventually saw like we did. I don't think it'll be like 2022 onward where we drop. Maybe, wouldn't be surprised maybe to see another 20% correction. But at some point, we're going to go back to these ebb and flow markets, because I have this new sentiment that we are no longer in this amazing phase. The best phase of the market, I think, was from 2010 onward. 2010 to about 2020. 2019 was like the best period ever. And now I think we're in a new era of the market where there's just going to be an extreme amount of volatility as tech dominance, the technological revolution starts to ramp up, and that compound effect hits harder and harder into the market, where we're pricing in so many future gains that as, people's mood of how quickly those future gains get adopted into the actual earnings, swayed these stocks, right? So, the price to earnings multiple, I think at a 20 to 30 is going to be the new norm. If we get over 30, like I said, I think we're going to bull market that's probably getting a little bit too frothy, but it's just annoying because I feel like a lot of dividend investors have not been rewarded yet, and they have been waiting so patiently watching these gains go by. And I was watching a video because SHD is being pronouncedly applauded for this wicked record high dividend that it just paid. But in retrospect, it's been one of the worst performing stocks, and it is a large position in my portfolio. I mean, you guys can see it. I mean, I've got an odd 75,000 CAD, which is a converted from the US dollars amount in here, 26% of the portfolio, right? Like it's by no means a small position, but it really represents, I think, the lower half of the S&P, which is largely reflected as not the best performing stocks, right? But PPC Ian pointed out that the dividends have not actually been that great at a growth pace. I mean, just take a listen, because from 2022 to 23, it was abysmal growth. I mean,
and when we look at 2023 versus 2022, an easy comparison here, I sum up all the distributions from 23, I sum them all up from 22, and I compare them. I put it in red, not because it shrunk, but because the performance is so bad. The dividend distributions, when we compare 23 versus 22, only grew by 3.77%. And so I think a lot of people looking at SCHD have an expectation, myself included, that the dividend is going to be growing very aggressively, because that...
Yeah, and that expectation in a higher interest rate market, I think, it's weird, because it's like opportunitively, this is one of the best markets to be a dividend-focused investor, but at the same time, you've missed out on some of the greatest gains the market has offered in the last several months, right? Because, you know, these companies, they're just dealing with higher interest rate payments, layoffs. They're dealing with so much that they haven't been focusing on the same kind of dividend increases. We're seeing it with the likes of Bell, and we've been talking about TD and some of these telecom giants. We'll take a look at in a moment. But some of those like Canadian counterparts and even the US counterparts are paying record high dividend yields. I mean, we've been doing some comparables with like Johnson & Johnson, because this is probably one of the most stable companies on the planet. It is down 20% with a dividend yield that it really hasn't seen since before 2010, maybe in 2012 actually. So you'd have to go back over 10 years before you would have seen a starting yield like this on a company that can definitely afford it. I mean, their revenues have started to recover. They're in a great foundational place, but nobody cares. No one's buying it because all their attention is on tech. Now, I don't know when, it's all fugazi in the near term. Nobody knows where these stocks are coming or going, but you got to recognize that if you are an income-oriented investor, you can't look at like what's going on in this moment with tech. Like, you really have to be patient, because the irrationality of all this can really drive you to make some big mistakes, especially now that the market's at a higher premium. Now, obviously, I always recommend cost averaging the S&P, but this isn't the worst time to continue to build that war chest. I state this like a broken record, that continue your cost averaging journey, but if the market, the broader market, like the S&P corrects by 10%, double up your monthly contributions and leave a little emergency fund, a market emergency fund aside for that, because that's how my portfolio has exploded in growth. Because if you go back and watch my videos when the market was dipping heavily back in October of 2023, like that's when I went crazy. I think I dumped like 10,000 to the market all within just a week from my savings, and that's why my savings rate too has gone down, right? I mean, I had 20K in cash, you know, back here, and then now all of a sudden I've gotten so frothy within the last several months because I just, you know, I recognize some of these dips and I really wanted to take advantage, and it's worked aggressively to my favor, right? But now you have to start asking yourself where you want to be in this market cycle, because to be super aggressive here, especially in tech, is a bit scary. Let's be real, it is getting very scary, right? Whereas you look at companies like TD that have been, you know, unfavorably, and there's been news that, you know, there's a reason these stocks have dropped, but when you look at their revenue and their dividends, like, again, like you can get full market rate of returns from just some of these companies' dividends. And then if the market ever recovers for some of these stocks, your rate of return is going to be very nice. Whereas if you're really thinking tech, you know, is in some form of an AI bubble, which I've been touting, we've been sitting in an AI bubble. Like, I find it absurd that Microsoft is kind of trading at an over 40 times multiple, hitting new all-time highs every single day, and now it has to justify this on the next earnings. We're getting in a frothy market here, folks. So my goals here, my plans kind of moving forward, taking a look at my tax-free savings account. I've got my tax-free savings account to a level now that is almost jaw-dropping to me, because now I'm getting back into above average market returns, which feels good because the goal is always to outperform the market. Taking those gains on Google in this account, repositioning some of it into the S&P, and buying some Tesla is continually working to my favor. As we can see here, my VDY position's holding the portfolio back, but again, I like having that regular steady income. It does help if the market decides to ever take a breath to have reinvestable cash that I'm not necessarily contributing just myself from my employment work. Now, I've gotten this account to a point where I have about $170,000 odd of contribution room. I just did the math yesterday, and as of yesterday, I have about $99,508 of contribution room still, and that just comes from starting at 23, buying really great companies companies that have excelled beyond market average returns, though that is not guaranteed. I've been very fortunate in my investing career now to have a decade of outperformance. But again, when you look at the last decade of the market, it wasn't that hard if you were just tech oriented, which I have been for the most part. Now, I am going to spend the next year, at least the rest of this year, really hammering this account. I'm going to rebuild my emergency funds back up, and I'm really looking to just shoveling endless amounts of cash as much as I can for the next 6 months in this account to the end of the year. Next year, my primary goal at this point is going to be distributing my income between paying the mortgage off early and then continuing to try and max out this account, because it's going to take some time. Let's be real. To try and come up with 100 G's to remax this account out is not something that can just happen overnight for me. Because again, I split a lot of my money between my corporation. And I have a job, but that, you got bills and expenses and a mortgage now. It's not like, I could just plop out 100 G's, though it looks like that. I mean, in several months to have like, these kind of gains and it's crazy, right? But that's not me contributing necessarily the full amount. So it's going to be a patient game here moving forward. My RSP, I managed to max out because I pulled some money out of my corporation, which luckily putting into my RSP completely waives any of the income tax I would have had to pay. And then on top of that, because I paid it out from the corporation as an expense, it should also waive any taxes that I would have paid on that $11,000. So I definitely saved quite a few $1,000s in taxes that I ended up putting a good chunk of that into Tesla and a little bit more into SCHD. If Tesla continues to rally at the rate it's rallying, which is, to be frank, quite absurd, and we get up to that $300 range, which I don't think we're going to do, but if it just absurdly ran that much and I was able to double my money in such a short period of time, I would take profit on it. I said I'd hold Tesla long term, but you got to recognize you get 100% gains in these short periods of time. I mean, it's so absurd. You have to take profits. And I would probably just take it out of my RSP and then recontribute it to SCHD as I've done in the past. But again, like I said, that is hearsay for now because I don't really care about a 30% gain. It's been a really short boost. It's been really nice to see, obviously, but I'm waiting for that August event for Tesla. I think August, when Tesla starts unveiling their new growth strategy, I think that could be a catalyst for an absurd gain in the stock, even beyond where we're currently at. And, if it takes it to that level, I'll take a bit of profit, but I am planning on holding some, at least for another good 1 to 3 years in my other accounts. I still think we got a lot of growth ahead of us for Tesla, but it depends on how much of that gets priced in too early. But at this point, I'd love to know what you think, because it's been a beautiful market for us, and I hope you guys are doing just as well. You're working hard, you're grinding it out, you're investing, you're doing what, I'm not a financial advisor, but I keep telling you guys, cost average in the S&P, pick a handful of stocks that you absolutely love, and I really hope you're seeing these kind of returns, because, I just feel like so many people went into high interest savings at the worst possible time. And, you guys, those people that just, thought that when the market was down the most and interest rates were up at the highest, that was the most opportune time to get into interest rated investments that just didn't offer any capital growth. It was such a detriment, I think, to, where the market was truly going to head. But I'll pass the question off to you. I'd love to know what you think in that comment section below.